Today's guest says 2026 opened on a strong note for Philippine equities, driven by robust foreign inflows and a more dovish Bangko Sentral. All that, though, seems to have been upended by the weekend joint strike by the U.S. and Israel on Iran. To walk us through his base case, the risks, and what it all means for stock investors, we're joined by Mark Canizares, the head of equity at Manulife Investment and Trust Management Corporations. Good seeing you again, Mark, and welcome to the program.
Yes, good morning. Good morning, Kat.
What a change a weekend makes.
Yep.
When you woke up Sunday morning and saw what just happened and what happened in the Middle East, tensions escalating, what did you think about Philippine equities?
Well, of course, we were trying to assess. It was early days that weekend, right? So one of the things we had to check was we needed to quickly assess whether this will be a long drawn-out war or will there be a quick resolution to this, similar to what we've had before. There was like a 10-day conflict before. So clearly, with the events that has happened over the last 48 hours, the market is still split on whether it will be resolved soon or whether it will draw out. And statements from the United States are pointing to something that might be like more than 4 to 5 weeks. So
Indeed.
From there, we have to reassess how it will impact Philippine equities.
And in that reassessment, the scenario building that you do, I know it's probably difficult, but what have you got ahead for your clients? I mean, what are you now telling them? It might take longer, and these are the scenarios.
Well, in terms of what we see for the market, as you pointed out, we started the year on a high note. Prior to that weekend, the market was up close to 10% for the year. And since November, we were up about 20%. So we're actually outperforming the markets. We're cheap, the typical, and we were coming off from that political issue, the political noise in the second half of the year. So we were already thinking that, 2026 might be a good year for the Philippines. But this is something that's external to the Philippines, and everybody's affected. So I think in terms of an asset class, it will indeed weaken given the uncertainties. For the Philippines, unfortunately, we are a net importer of oil, but we're not just the only ASEAN country or the only Asian country. We're one of the top 5 within Asia region that imports oil. So that's one thing we're closely watching out for in terms of what the supply shock will do to Philippines in terms of the costs for companies. One thing also that's a little bit negative for the Philippines is, yes, it's not only the Philippines that imports, but we're starting the year off against our Asian neighbors with the worst current account deficit. So we're at 2.7%, I think, as of the fourth quarter annualized. So if there is indeed a prolonged war in the Middle East and it causes a supply disruption, then the impact might be bigger for the Philippines. The other thing that we're closely watching out for is the impact to consumption, because the Middle East is one of the territories globally that land-based OFW deployments are the highest. I think we're close to 40 or 50%. So if you think there's an impact there, when we try to assess the impact to the economy, that might be closer to about 1% of total GDP that can be disrupted. So it's more of the flow of that money that's stopping that might have an impact on the domestic stocks in the Philippines.
And the foreign fund flows have spoken. We've also outperformed on the downside. Looking at the initial impact, it was a 2.25% decline, when the rest of the Asian region was just losing about maybe half to 1%, thereabouts. Where are the foreign funds right now? Are they rotating out of assets that they perceive are havens, or have they really moved out of the country?
Well, two things. So the war has caused everybody to de-risk a little bit. That's the initial reaction, right? And in terms of investor positioning, foreign investor positioning for the Philippines, remember, everybody's asset light on the Philippines. So there is almost no delta for foreign investments to come out. It's at very low levels, which is why at the beginning of the year, we were already thinking investors can come in. And indeed, we saw that when investor sentiment, especially foreign investor sentiment, trickles and goes back to the Philippines, the market actually responds well. But I think at this point, as you've pointed out earlier, they are also looking at safe haven assets like gold, just to see where the conflict, or at least what will happen when the fog of war lifts, before reassessing their picks. But looking at the Philippines in isolation in terms of the companies in the market, we have derated quite a lot. So we're actually looking at potential re-rating prior to this, because what we're waiting for was, a constructive view on how government spending will improve.
Right, but that was before all
Correct.
this happened
Yes.
over the weekend. So what now for that re-rating? Is it long gone? And what impact might it have on the trajectory that we expected that the Bangko Sentral may have? Because, as you did say, we are a net importer of fuel, and that really is one commodity that's shot up and continues to shoot up right now.
Well, remember in February, the central bank actually cut rates by 25 basis points, and the market was still looking at one hike or two hikes for the remainder of the year. But certainly with the supply
Did you say
issue,
hikes or cuts?
Cuts.
Right.
But with the central bank, with inflation looming higher on the horizon, we've seen over the last 24 hours that narrative has changed, that might actually be off the table. But of course, it's all tentative, because even in the last BSP action, they were also tentative on the data. So it diminishes that possibility of a cut, given that oil prices might increase. But of course, everything is very fluid at this point, because every day the situation changes in the Middle East.
It is, and it's really confidence, that confidence shock that the central bank governor was mentioning over and over again during the media briefing. And then came the Middle East crisis. So what now for the way that you're structuring your fund? You did outperform the benchmark last year, minus 2%, but the benchmark fell by 4%. How are you hoping to outperform in a scenario where flood control problem isn't just the issue?
Well, I think one thing that we've learned from last year, the Philippine markets have been moving sideways for years. So it requires you a little bit of flexibility in terms of being tentative on what you do, tactical positionings in the market. The other thing that we like with the Philippines that has developed over the past 2 to 3 years is that yield plays, defensive plays have actually increased, and that has worked well for the markets in terms of volatility. You now have REITs as an asset class, which was not there 5 years ago. You now also have, as of the fourth quarter of this year, last year, another water utility that also gives you defensiveness in terms of your portfolio. So it wasn't the PSE, or the market is not what it was maybe 2 to 3 years ago, like even when COVID hit, that we didn't have too much of those defensive names, except for the typical utilities like your telcos, your power companies. But the REITs and other, the deeper listings or the newer listings are now providing investors with an additional shield, so to speak. So if they want to stay invested and not use cash, there are now more defensive plays in the market that you can use to shield your portfolio while this is ongoing. And once that cloud lifts, then we can start reassessing where the value is actually.
There goes the silver lining there on the yield plays.
Yep.
Thank you so
Thank
much,
you.
Mark.
Thank you.
Appreciate
Thank you.
the insights. Mark Canizares of Manulife Investment Management and Trust Corporation.